SEBI just changed the rules for IPOs. From November 30th, the anchor investor quota, basically IPO allocation for institutional investors, is getting bigger, moving from 33% to a massive 40% of an entire IPO. The immediate question everyone is asking is this a scam to help big funds? Does this rig the game even more against me, the retail investor? In the next few minutes, I'm going to tell you exactly what changed, why SEBI is really doing this, and give you the one strategic change you must make before you apply for the next big IPO. The real problem is that IPOs already feel like a lottery, and new rules change feels like the system is just making it harder for the little guy. It feeds that narrative that the game is rigged. But hold on, let's first try to understand exactly what has changed. Earlier, 33% of an IPO was reserved for anchor investors. Now that has been bumped to 40%. But here's the crucial part. SEBI has split that 40%. 33% is now specifically reserved for domestic mutual funds. And a new 7% quota is created for big, long-term, permanent players, the likes of insurance companies and pension funds. Think LIC or even your NPS fund manager. And if those insurers and pension funds don't use their full 7% quota, it spills over to the mutual funds. This isn't just a small tweak. This is SEBI rearranging the VIP section of the IPO party and cordoning it off for domestic players. Now let's try to understand why is SEBI doing this. The official reason is to enhance market stability and reduce dependence on foreign investors. In simple words, SEBI got tired of hot money from some foreign funds buying an IPO one day and then dumping it on the listing day, causing that insane volatility that often burns retail investors. They are inviting slower, stickier domestic money who are less likely to sell in a panic, because they usually have a 10-year horizon and not a 10-day one. So is this bad for us, the retail investors? No, it's in fact quite the opposite. The real story here is what did not happen. A few months ago, there was a proposal to cut the retail investors' quota from 35% down to just 25%. SEBI thankfully dropped that plan. They kept the 35% retail quota untouched. This is SEBI just trying to make the anchor investor participation a more reliable signal of quality by forcing it to be more domestic. And hence, this rule does not change your allotment chances. They were already terrible and they remain equally terrible now. What has changed is the quality of the signal. Your new strategy is to stop obsessively looking at the grey market premium, GMP, and start studying the anchor list. Basically, the anchor list is the new GMP. If you see an anchor book that is heavily oversubscribed by domestic mutual funds, LIC, and big pension funds, that is the strongest green flag of the quality of the company. Because the smartest, slowest money in India has vetted the company and wants in for the long haul. That's the signal to follow. Let me know which IPO are you looking forward to invest in. And see you tomorrow.